2 days after Christmas, a single SEC filing exposed the switch. The biggest force leaning on silver just stopped leaning and started buying. Not a leak, not a rumor. A public disclosure, stamped and filed, dropped in the quietest attention window of the year. One of the world's largest banks revealed it went from basically zero silver miner exposure to about $873 billion in 1 quarter. That is not diversification. That is an emergency move. Quick intro, this is our channel, our community, and we do one thing. We follow money when it tries to hide. Now watch this. They didn't announce it on TV. They didn't explain it in an interview. They buried it inside routine institutional paperwork, the kind most people never read. And the timing is the tell. Holiday weekend, thin desks, slow headlines, low attention. When powerful players change sides, they do it quietly, before the crowd realizes the board flipped. Here's what happened in plain English. A quarterly 13F filing hit the SEC system, and inside it sat a brand new basket of silver mining positions. Huge positions. Not a nibble, not a starter trade. Positions big enough to matter, big enough to move voting power, big enough to say, we need upside exposure now. The disclosed total was roughly $8, $73 billion, spread across multiple silver-linked names. And last quarter, nothing. So in 1 quarter, they jumped from no sector position to we own a piece of the supply chain. That's the pivot. And if you've held silver through years of price whiplash, you already feel what that implies. Because when the loudest bear starts buying bull instruments, the market's psychology snaps. Here's the mistake most people make. They see mining stocks and assume this is just another trade, a portfolio manager chasing a theme. But that's not what this smells like. This smells like a lifeboat. Because miners are not just stocks. Miners are claims on future ounces. Streamers are claims on future ounces at fixed prices. When physical markets tighten, those claims become priceless. Now, before we go deeper, let's get one thing straight. A 13F is not a press release. It's a compliance requirement. Big institutions have to show certain equity holdings on a schedule. So when you see something shocking in a 13F, you're not watching marketing. You're watching a footprint. And footprints are honest in a way interviews never are. Also, 13Fs are delayed. That's important. It means the buying likely happened earlier in the quarter, not the day you read it. So the real question isn't why did they file? They have to file. The real question is why did they build the position in the first place? And why dump the filing into the holiday noise? That's the open loop. Hold it. Because to understand the motive, we need to look at the pattern of what they bought. They didn't buy one miner. They bought a lineup. Different models, different risk, same direction. That signals strategy, not curiosity. One of the biggest disclosed positions was a precious metals streaming business, tens of millions of shares, multi-billion-dollar value. Streamers matter because they don't run trucks and drills every day. They buy metal under long contracts at low fixed costs. So if silver rises, margins don't just improve, they detonate. Then there's a major primary silver producer, another massive stake. Producers matter because they control flow. They turn geology into deliverable ounces. When silver is abundant, they're just companies. When silver is scarce, they're strategic assets. They also scooped a high beta silver miner, the kind that moves like a slingshot when sentiment shifts. Why would a conservative bank want slingshot exposure? Because when you're trapped on one side of a move, you hedge with speed. You hedge with torque. You hedge with something that can outrun your losses. And the rest of the basket, mid-tiers, developers, names that can double in a month when the tape turns. That matters because it tells us they weren't shopping for safe. They were shopping for asymmetry. Now here's the part nobody wants to say out loud. This filing doesn't scream confidence, it screams constraint. Because if you could simply close a problem position, you'd do it, quietly, cleanly, without spending nearly $9 billion building a new hedge. So what constraint would force this? Let's separate fact from interpretation. Fact. They disclosed dramatic Q4 build into silver mining equities. Interpretation. That build fits a classic playbook used when an institution is short exposure. It can't comfortably unwind, especially when physical markets feel tight. We won't fake certainty. But we also won't pretend this is normal, because it isn't. Here's the logic in one picture. If silver is water, futures are the water bill. Paper says you have water. But when taps run dry, you don't want the bill. You want the well. Miners are the well. Streamers are the well with a locked purchase price. So if you're short water, and you can't source water easily, you buy the well. That's position inversion. Now watch this, because the word sounds fancy, but the move is brutally human. When you're losing on a bet and the market is moving faster than your ability to exit, you don't try to stop the train. You jump onto a faster vehicle and ride in the same direction to survive. That's inversion. Short on one side, long on another, hoping the long accelerates more. And miners are built for acceleration. Why? Because miner profits are a lever. Revenue rises with price. Costs rise slower until they don't. So for a while, price up means margins expand, and markets pay insane multiples for expanding margins. That's how miners can move like rockets when the metal moves like a drone. Let's make it concrete without pretending we know their exact book. Say an institution has exposure that loses money if silver rises through futures, swaps, structured notes, whatever. If silver jumps 30%, their loss grows. But if their miner basket historically moves 3x the metal, that same 30% jump can mean a 90% rally in miners. That's not a guarantee, it's a behavior pattern. And if you're staring at a risk report, you don't need certainty. You need a plausible escape route. That's why this basket looks like a hedge designed to overcompensate. Now here's the contradiction that should make you sit up. If this institution is now meaningfully long miners, then who is left to cap the rally? For years, silver rallies have felt like they hit an invisible ceiling. Every push gets smothered. Every breakout attempt gets sold. We don't need to argue motives to observe the behavior. But if the weight on the lid starts buying the spring, the lid loses pressure. And springs don't politely trend, they snap. Let's pause here. There's a psychological trap in markets where people think the enemy is a person. It's not. The enemy is incentive. If a player used to profit from suppressing a move and now profits from letting it run, the narrative changes. The research changes. The media tone changes. Not overnight, but it bends. Because stories follow positioning. So the question becomes, if the incentive flipped, what's the next domino? Now watch this, because the domino is not retail. Retail is loud, but retail is small. The domino is copycat capital. Every major fund, every bank desk, every quant system that monitors institutional holdings will see the same signal. 0 to billions. That's a siren. They will interpret it as something is breaking or something is about to break. And even if they don't care about silver, they care about being last, so they buy. And when they buy, they don't buy carefully. They buy liquid names, they buy the same handful of tickers, they crowd the same doors. That's when you get the moves people call irrational. But it's not irrational, it's physics. Too many dollars chasing too few shares. Now, I want to underline something. A 13F shows equity holdings. It doesn't show the derivative book. It doesn't show the swaps. It doesn't show the off-balance sheet games. So we don't pretend this filing is the full picture, but that's exactly why it's valuable. Because it's the one part of the picture that has to be public. If someone is trying to patch a hole with a visible patch, that suggests the hole is big. Now, let's talk about why silver is uniquely dangerous for shorts. Silver is a split personality asset. It trades like money when fear rises. It trades like an industrial input when the economy moves. And that dual identity creates moments where demand shows up from two directions at once. Investment demand, industrial demand. When both pull at the same time, the physical market tightens quickly. And when physical tightens, paper games get exposed. Here's the metaphor. Paper markets are a casino. They let you bet on the idea of silver. Physical markets are a grocery store. You either have the goods or you don't. When the grocery store shelves start thinning, the casino can keep taking bets until someone asks for delivery. That's when the casino discovers it sold more claims than it can honor. And that's why institutions fear physical tightness more than price charts. Because price can be hedged. Delivery failures create headlines. Delivery failures create regulators. Delivery failures create systemic conversations. So if you're an institution staring at any chance of a delivery squeeze, you don't just manage P&L. You manage reputation. You manage solvency optics. You manage political risk. Now, is it possible this is just a normal allocation change? Possible. Maybe a new portfolio manager, maybe an internal mandate shift, maybe reclassification. We're honest about that, but here's the thing. Normal allocation changes don't appear as a sudden multi-billion-dollar basket built across multiple high-leverage vehicles. Normal changes don't choose the holiday dead zone to surface. Normal changes don't look like they were built to benefit most from exactly the scenario that hurts shorts. A sharp, disorderly upside move. So we watch incentives. Now we get practical. What do we do with this information? First, we don't worship it. Following giants blindly is how you get crushed. But we also don't ignore it, because signals like this are rare. So we treat it like a weather report, not a prophecy, a report. It suggests pressure in the system, and we position with risk controls. Let's pause again. If we're wrong, where will it show first? In the next round of disclosures. And whether these positions stay, grow, or vanish. And whether other big institutions copy the move. Because the real catalyst isn't only what they already bought. It's what others do when they see it. Every major fund runs screens on filings. They hunt for signals. And when they see a giant go from 0 to billions, they don't shrug. They ask, what do they know? Then they chase. That's how institutional herding works. And silver miners are a small room. When big bodies walk in, prices don't walk, they jump. So here are 2 questions for the comments. Answer fast, no essays. Do you think this buying is a hedge or a confession? And if the biggest bear flips long, who becomes the next forced buyer? Now let's talk about what we do. It's without fantasy, without bravado. 1 line first. This is educational. We manage risk. If you own physical silver, your edge is time. You're not a bank. You don't have a margin clerk calling your phone. Your enemy is emotion. They'll use volatility to make you doubt yourself. They'll use bubble headlines to make you feel late. They'll use sharp drops to make you feel stupid. That's the game. Our job is to ask 1 question every time. Did the thesis change, or did the screen just get loud? And here's a little trick. When paper price dumps but physical premiums don't, that's a clue. When the chart looks weak but delivery delays stretch, that's a clue. When headlines scream crash but the real world still can't source metal easily, that's a clue. We watch the real world, not just the candle. If you hold miners, your job is selection and patience. Miners are volatile by nature. They can surge and they can get punched on broad market sell-offs. So we focus on quality, balance sheets, and true exposure. We avoid the trap where a silver miner is actually hedged, diluted, or barely silver at all. Because you can be right on silver and still lose on a poorly structured stock. What does hedged mean in 1 line? It means the company sold future production at fixed prices. So when silver rockets, the miner doesn't. You don't want that in a squeeze narrative. You want real upside. You want a company whose cash flow expands when the metal expands. If you're in cash, waiting for confirmation, the risk is obvious. By the time it feels safe, the move is half done. Markets don't ring bells, they ring alarms after the fire starts. So we plan entries instead of chasing candles. We scale instead of YOLO. We keep dry powder for pullbacks. We refuse leverage we can't control. And we watch the next filings like hawks. Now watch the timing again, because this is where the chess shows up. Filing on a holiday weekend is like whispering during a fireworks show. You technically spoke, but you chose a moment where nobody could hear. Markets run on attention as much as they run on data. If attention is low, reactions are delayed. If reactions are delayed, positioning can be completed before the stampede. So the advantage isn't that the filing exists. It's that most of the world will discover it late. And late discovery creates one of 2 outcomes. Either the market shrugs and the signal fades, or the market wakes up suddenly all at once, and we get a crowded chase into the same names. That chase window opens when desks return, when analysts are back, and when screening systems start flashing unusual institutional accumulation. That's why the next 60-75 days matter, not because of a magic calendar. Because that's how long it takes for big money to notice, debate, and deploy. So what do we watch during that window? We watch volume spikes without news. We watch minor ETFs seeing steady inflows. We watch options skew tilt bullish. We watch whether the strongest miners refuse to break down even when the broad market wobbles. If that happens, it's a clue that a bid is sitting underneath. And if that bid is institutional, it doesn't get tired after 1 green day. It keeps coming. Here's the cliffhanger. If this was the first move, the next is the copycat wave. And after comes the moment that copycat wave becomes visible in the next disclosure cycle. When that hits, the story won't be silver is interesting. The story will be the big money already moved. And by then, the easy positioning is gone. Now, another open loop. If a bank holds meaningful stakes in multiple miners, what else does it gain? Influence. Not control the world. Influence, real practical influence, voting power, boardroom attention, the ability to support consolidation, the ability to encourage disciplined capital allocation. And in a tight market, discipline matters. Because when supply doesn't respond quickly, the price becomes the only balancing mechanism, and supply can't respond quickly. Even if every miner wanted to ramp today, mines aren't factories. Permits take time. Equipment takes time. People take time. Geology takes time. So when demand bites, price moves first, supply follows later. That lag is where squeezes are born. Now let's talk about the moment this becomes viral. It won't be when the filing drops. Most people don't read filings. It becomes viral when someone connects the dots in a headline. Major bank loads up on silver miners. Then the crowd rushes in. Then the crowd discovers the sector is tiny. Then the crowd competes with institutions for the same shares. And the chart starts doing violent things. That's the sequence. And here's the ugly secret. Institutions like volatility. Volatility lets them accumulate cheaper. A big player can buy into fear, then let price rise into FOMO, then buy again on the next shakeout. Retail usually buys the top and sells the dip. Institutions reverse that. So when you see the inevitable smash day, ask, is this a thesis break or a harvest? Now subscribe, short and simple, because we track filings, flows, and the small clues that mainstream headlines miss. And here's the final warning. If this is a real repositioning, the next wave of buying won't look dramatic at first. It will look like normal strength, then strong volume. Then why can't this dip stay down? Then one morning you wake up and the gap is already printed. And the people who waited for permission are suddenly paying premiums for exposure they could have built calmly earlier. So don't get hypnotized by the daily candle. Watch the incentives, watch the filings. Watch who used to fight the rally and is now positioned to profit from it. Because when the people who used to stand against you suddenly stand beside you, it's not because they love the trade, it's because they're scared of what's next. And if they were scared enough to move about 8, $73 billion in one quarter, what do they see that most people still don't? That's the next thread we're pulling.